Right now, it is Sunday night. Markets open in less than 12 hours, and I need every single person watching this to understand exactly what is sitting on the other side of that opening bell, because the data that came in over this weekend is not normal. This is not a typical Sunday preview where I tell you to watch support and resistance levels. What I am about to walk you through is a collision of 5 separate crisis events that are all converging on Monday morning simultaneously, and if you are not positioned correctly before that bell rings, you are going to spend the rest of this week wondering what happened. Let me start with the number that matters most right now. Silver closed Friday at $85.29 per ounce. That is up $2.39 on the day, a 2.88% gain. And on the surface, that looks like a healthy recovery. But underneath that number, the market is fracturing in ways that the spot price is not reflecting yet. Friday's daily range told the real story. Silver hit a low of $80.96 and a high of $84.90. That is a $4 intraday swing. That kind of volatility does not happen in stable markets. That happens when two opposing forces are pulling the price in opposite directions with equal violence, and by Monday morning the balance between those forces is about to break. Here is why. On Friday, the U.S. Bureau of Labor Statistics released the non-farm payrolls report. Unemployment jumped to 4.4%. That is above the market estimate of 4.3%. That single data point just changed the entire rate cut calculus for the Federal Reserve. Kevin Warsh, the newly nominated Fed chair, has been positioned as an inflation hawk. The market was pricing in zero rate cuts through mid-2026, but a deteriorating labor market at 4.4% unemployment creates a trap. The Fed cannot keep rates elevated while the economy is softening, and if traders start pricing in emergency cuts on Monday morning, the dollar weakens and silver explodes higher. That is the first domino. The second domino is oil. Brent crude closed near $92.69. WTI settled at $81.01. These are not normal energy prices. These are war prices. The Strait of Hormuz, which carries 20% of the world's crude oil, has been effectively closed since the United States and Israel launched their coordinated strike on Iran on February 28th. The killing of Iran's supreme leader Ali Khamenei triggered retaliatory missile strikes across the Persian Gulf. A U.S. submarine sank an Iranian warship off the coast of Sri Lanka. This is the first time the United States has sunk an enemy vessel since World War II. And this weekend, reports emerged that U.S. evacuation orders have been issued in parts of the Middle East amid threats of imminent escalation. If Monday opens with any new military development in the Gulf, silver is going to gap up violently because energy-led inflation is the single strongest catalyst for precious metals in modern market history. Now here is the third domino, and this is the one that almost nobody is covering. Over this weekend, I have been tracking COMEX warehouse data. On Friday alone, over 2 million ounces of silver were physically withdrawn from COMEX vaults in a single day. Total registered inventory has plunged to between 81 and 103 million ounces. To understand how dangerous that number is, you need to know that March 2026 delivery demands have hit 52.63 million ounces. That is 10,526 contracts standing for physical delivery. The open interest across all contracts sits at 429 million ounces against that 81 to 103 million ounces of registered stock. That is a 4.6 to 1 paper to physical ratio. For every single real ounce sitting in those vaults, there are nearly 5 paper claims against it. The drains are accelerating at 650,000 to 785,000 ounces per day. At that rate, these vaults could be functionally empty within weeks, not months. And here is what makes Monday specifically dangerous. There are still 1,839 open contracts representing 9.2 million ounces of potential additional delivery demand sitting on the books. If even a fraction of those holders decide to stand for delivery on Monday, the mathematics of this market break. The COMEX has two options when that happens: deliver metal it does not have or force cash settlement. JP Morgan already took private cash settlements last week with 0 bars physically moved. That is the exchange quietly admitting it cannot fulfill obligations in metal. If that becomes public knowledge on Monday morning, you are looking at the biggest single-day premium explosion in silver market history. The fourth domino is the physical market in Asia. While you were sleeping this weekend, the damage from last week's emerging market collapse continued spreading. South Korea's stock market crashed 18% in a single session on Wednesday. The Indian rupee hit 91.7 to the dollar, shattering every previous record. The Reserve Bank of India confirmed it is burning through foreign exchange reserves trying to stop the free fall. And when Asian currencies collapse, the population does not buy bonds or Bitcoin. They buy physical gold and silver. That is a cultural response that has repeated for thousands of years. Shanghai silver premiums are now $8 to $12 above Western spot prices. That is a 9 to 17% premium over paper. What that premium tells you is that physical metal in Asia is worth dramatically more than what the comic screen says. And that price gap is pulling metal eastward. The refineries in Singapore and Perth in Switzerland that normally export to American dealers are selling locally at higher premiums with immediate payment instead of shipping across the Pacific for lower prices on a 2-week delay. The pipeline to the west is not slowing down. It is being redirected at the source, and your local dealer's ability to restock depends entirely on that pipeline. The fifth domino is Mexico. This is the supply-side catastrophe that the mainstream financial media refuses to cover. Mexico produces 28% of the world's silver. In February, the death of Jalisco New Generation cartel leader El Mencho triggered a wave of retaliatory violence across western Mexico's mining regions. On January 23rd, 10 employees of Vancouver-based Vizsla Silver were abducted in Sinaloa. As of March 5th, 7 are confirmed dead. Fresnillo, the world's largest primary silver producer, has cut its 2026 output guidance to 42 to 46.5 million ounces, down from over 50 million. Transportation insurance for silver bars in Mexico has become virtually unobtainable. Geologists and technical staff are refusing to work in the country. You are watching 28% of global silver supply become a war zone in real time. Now combine all 5 dominoes: a weakening dollar from rising unemployment, a war premium from the Middle East energy crisis, COMEX vaults draining at historic rates with delivery demands exceeding available stock, Asian populations hoarding physical metal and redirecting global supply chains, and Mexico's silver production collapsing under cartel violence. All 5 of these forces are hitting the silver market simultaneously on Monday morning. But there is one more layer that makes this even worse. A global shortage of nitric acid has crippled the scrap silver refining market. Refineries need nitric acid to process old jewelry coins and flatware into investment-grade bars. China has restricted exports of this chemical. Silver lease rates have exploded past 100% annually, making it impossible for refiners to hedge metal during the 10 to 15-day processing cycle. Refineries are in triage mode, only processing high-purity industrial doré bars for semiconductor and solar manufacturers. The secondary supply of recycled silver, which normally provides a relief valve during shortages, has been completely shut off. This means that even if you wanted to sell your silver right now, you might face a 30 to 40% haircut at your local pawn shop because they cannot send it to a refinery that will process it at a reasonable cost. Your silver is worth $85 on a chart, but the physical market is so broken that buying and selling at rational prices has become nearly impossible for retail participants. Let me give you the institutional predictions so you understand what the smart money is positioning for. Bank of America's Michael Widmer has projected silver at $309 per ounce by end of 2026, based on the gold-to-silver ratio collapsing to 14 to 1 during this crisis. Gold is at $5,158. At a 14 to 1 ratio, silver goes to $309. Citigroup projects $100 by the end of March and $110 by the second quarter. Even the most conservative forecast from JP Morgan has an annual average of $81, which is where we already are 7 weeks into the year. Willem Middelkoop projects $500 as inventories drop 30% further. The deficit stands at 67 to 200 million ounces annually, with a cumulative 1.5 billion ounce shortfall projected by 2030. The year-to-date performance tells you the trajectory. Silver is up between 17 and 120% since January 1, 2026, depending on your entry point. Over the trailing 12 months, the metal has appreciated 163%. It reached an all-time high of $121.78 on January 29th before a violent correction that included a CME margin hike of 36%, forcing leveraged traders to liquidate. That correction brought silver down 47.5% to $63.90. The recovery back to $85 has been driven entirely by physical demand overwhelming paper selling. Here is what you need to understand before Monday. The technical picture shows RSI at 51.1, which is perfectly neutral. Support sits at $76 to $80. Resistance is at $86.25 to $86.57. The 20-day moving average at $83 and the 50-day at $84 are providing dynamic support. A break above $86.57, the 61.8% Fibonacci retracement, opens the door to 90 and beyond. A break below 80 triggers a retest of 76. Monday's opening price action in the first 30 minutes will tell you which direction this market has chosen. The window is closing. The COMEX countdown is accelerating. The physical supply chain is fractured across 3 continents simultaneously. And the macro environment with war, inflation, currency collapses, and labor market deterioration is creating the exact conditions that have preceded every major precious metals breakout in modern history. If you are watching this on Sunday night, you still have time to prepare. If you are watching this on Monday afternoon, you are already late. Subscribe to Silver Eye and turn on notifications because this week is going to move fast, and the updates I am putting out over the next 5 days could be the difference between being positioned ahead of this market and being left behind entirely. I will see you Monday night with the first real-time damage assessment. Stay sharp, stay informed, and do not let Monday catch you off guard.